On today's hot sheet, I'm discussing housing inventory, catching up on that, new and existing home sales, pending home sales, mortgage applications, home price indices, and job openings, as well as labor turnover survey and ADP's employment report. We got basically a whole week of hot sheet wrapped into one. Today is Thursday, October 2nd, 2025. I am Byron Lazine, and the hot sheet starts now. Okay, a lot going on, especially with the week that we've had over here at BAM. Obviously missing the entirety of the hot sheet week. Bobby had to do this is maybe one of the most psychotic moves ever, had to do a LaGuardia to Naples, back to LaGuardia Airport in one-day trip to come down here and work on the studio. We had some studio issues over the past week. We got them finally kind of back up and running at some point yesterday. For those of you that were part of the BAM webinar, we were back up and running for that. And I'm pleased to be here with you guys today. Hopefully we never again have those issues. There are multiple things happening in here. Bobby's brought down backup plans for backup plans to make sure that if we have equipment issues, technology issues, we're going to be able to bring you this show. So my apologies at the end of the day. Should have had the backup plans in place, but we didn't. And here we are today. If you were wondering if we shut down the hot sheet because the government is shut down and we're waiting for them to get back up and running, don't worry, we're back. I don't know what the government is doing. Who knows what they're doing? It's almost like, do you even notice if they're when they are up and running? But all right, let's get back into this. All right, so we didn't cover inventory. I'm going to try to cover as many topics that we would typically cover in a week. We had to carve some things out, but I do want to play catch up a little bit. And I want to play catch up first, starting with inventory for the past week. If you haven't caught up on it, I thought it was interesting. Inventory, we got that kind of pop after the Labor Day holiday, if you remember. And we were looking to see if that was going to increase inventory throughout September. If we remember 2024, we actually were able to gain on single family inventory throughout September, and not just in a small way. It was meaningful gains. When we look back last year throughout September, we started at about 704,000, and then we ended September at 731,000. So there was a plus 25, plus 26, plus 27,000 on single family homes. We're not going to get there. We didn't get there in September. We'll get obviously the last week of September as we meet together for Monday's hot sheet. But we started the month of September at 860,000. And as of the beginning of this week, we were only at 862,000 on single family inventory. We actually had that drop after the holiday where we went all the way down to 846. So we got that back. We never saw a holiday drop last year. We saw inventory just continuing to climb. So we came back, got that back. We'll potentially, given what happens the last few days of September, which we'll see on Monday, are going to have a net positive month for September, unlike August where we had net negative on inventory, but still not a significant gain like we saw, deep into the summer months in 2024 and into the beginning of fall, where we continued to gain before that seasonal decline happened in mid-October. Now our seasonal decline might be starting a little bit sooner, similar to where it would start in a more normal year. Okay. If you look back 2019, the last normal year we can reference in real estate, the seasonal decline, once September wrapped up, it started. I mean, it kicked in October. You didn't see 2 weeks in October of gaining on inventory like you saw in 2024. 2019, October hit, which we're in now here today. You saw the seasonal decline, and the next 90 days, it was just that, a seasonal decline. That's normally typically what will happen. So as you have conversations with sellers, something I was just talking about with my team, there's a question that gets asked a lot from consumers. Hey, when's going to be the best time for me to sell my house? I'm thinking about selling, but I'm thinking about putting it off till next year. And a lot of agents say, well, I mean, now is a great time because of X, Y, and Z. And it's like, why does agents always tell me now is the best time to sell? When in reality, there's an argument, depending on your market, that you could position your property now because of, what we just talked about, this inventory decline, homes coming off the market, which means less competition for those sellers. But what we also know about now is that there's less buyers. The most buyers in the market at any given time nationally, and this is dependent on market, is going to be in April. And that's why Realtor.com every year identifies the best time to sell your home being in April, because you haven't gotten, after you have this decline of homes coming off the market here over the next 90 days, it takes a little bit. Nobody does anything in January except buy a gym membership. So it takes a little bit of time for that inventory to come back. January, February, it's kind of the bottom and flattening out of inventory. And it's not till March and beginning of April where you start to see those numbers actually move up on inventory. Okay. If we go back to just the beginning of this year, that remains true. You had a flat inventory level on January and February, and then it wasn't until March and April that we saw inventory to increase. But this is the sweet spot. As it increases before it gets maxed out for the year, March, April, significantly happening in April where you have the majority of the buyers, that's when truly is the best time to sell, March or April, or to have your home on the market and be agreeing to a contract so you can get the highest price point, which typically happens in June in any given month. So just some things to think about over the next 90 days. You're talking about sellers and they ask you the question, well, I'm thinking about selling. It's going to be maybe next year. I could sell at the end of this year. I don't really know what to do. When's the best time? Well, is it a speed situation or is it, you want to make the most money? Because if you want to make the most money, there actually is, some data points that you can follow that we just walked through to put yourself in position at the beginning part of next spring before the competition comes on to make the most money. If it's a speed lifestyle matchup, wanting to move the money to something else, then it's choice B. So it's really, is it A or B? Is it speed or is it money? And that's going to help us guide a plan for you. Okay, new listings here for the past week. We came in at 65,000 on new listings off of about 63,000 the year prior. We're still kind of just entangled in what, weekly new listings look like in 22, 23, and 24. So not a lot of big changes on the new listing front over the past week. Price reductions are still relatively in a high spot, 41.6% versus 39% the year prior. This is higher than most normal years. Most normal years, you have about a third of properties at a reduced price, but before actually selling. Right now, we are seeing a higher level. Sellers are they're a little bit frustrated. I talked about it in the BAM webinar yesterday. They're either frustrated because it's not as easy, quick to sell as it was for their neighbors just a few years ago. They're not getting quite the number that they expected. They're not getting that bidding war. And there's a frustration unless they have a really strong agent in their corner walking them through the expectations of what the market is doing right now. Okay, pending home sales, 65,000 versus 62,000. So we are seeing over the last couple of weeks a slight bump up here on weekly. That'll show up in about 60 days on existing. So weekly pending sales are getting a little bit better, albeit we're still trending at about 4 million home sales right now. We'll dig into those numbers here shortly as well. All right. There's your inventory update. I want to move off of that because we have a lot here to cover. By the way, in the chat, just if you're glad the hot sheet is back, throw a 1 in the chat. If you're glad it's back, it's only a 1-day week this week. I apologize. We had the issues. Bobby had to do a round trip 1 day LaGuardia. Throw a 1 in the chat if you're glad to have the hot sheet back. I'm thrilled to be back with you guys. So it's a pleasure to be here. I want to go to new home sales. This came out for the month of August, hit early this week. New home sales released by the U.S. Census Bureau come in at 800,000 for new homes sold. So new homes, new construction, new residential construction. 490,000 is the number. This is a seasonally adjusted number. The previous was seasonally adjusted annual rate. Comes in at 490,000 for for sale inventory, and the median sale price for new homes comes in at 413,000. Remember, the median sale price on new has actually dropped below existing, which is rare. Speaks to the inventory levels that builders are dealing with, but has it got better? Well, sales certainly have for builders. Okay. So we see that uptick over the last few weeks on pending home sales, and builders are getting the benefit of that. Look at the sharp increase here on homes sold for the report in August. Let's dig into some of the data. New homes sold in August 2025 at that 800,000 number. That comes in at 20.5% above the July 2025 rate of 664,000. 800,000 versus 664,000 on a seasonally adjusted sold rate. So these numbers are bucking a trend of the previous couple of months where builders were, really in a bad spot. 15.4% above August 2024 rate of 693. So, I mean, in 1 month, July 25 to August 25, you got a 20.5% pop on a seasonally adjusted annual rate of homes. That is quite a comeback for builders in a 30-day period. For sale inventory, the months of supply is another really good indicator for builders. Right now, months of supply is at 7.4. I mean, we got as high as 9.8 in August of last year. So you go August over August of last year, 9.8 months of supply, an extreme buyer's market, now down to 7.4 months of supply at the current sales rate in this August report. And 7.4 is much closer to 6 months, much closer to an equilibrium. So builders now getting a little bit of a tailwind, and they're seeing it in the data. Sales price happening at 413%. That's 4.7% above July's at 395. I mean, these are great numbers for builders. They're all coming in at a time of year where you typically don't see numbers increase. That's more of a June metric, and we're seeing it now in August for builders. We obviously saw a little bit of a relief on interest rates, but they've had that kind of, benefit at their disposal of getting the rates lower. Obviously, the lower the rates go, the lower they can even push with their incentives. But new home sales making a comeback. Good news there for builders. If we look at existing home sales now, these are right now showing a different story than what we're seeing in current pending weekly homes. So my anticipation is 60 days from now, we could see existing home sales actually move up. But right now we're seeing them move down. Okay. Right now, existing home sales went down month over month at 0.2%. On the year, up 1.8%. That puts us at a seasonally adjusted annual rate on 4 million. This is kind of the bottom number for analysts. This is the floor. Nobody expects us to get to 4 million or below. We've kind of been dragging on this number for now 3+ years. 4 million existing home sales, well below where in the beginning of the year, a lot in the housing industry we're hoping to get to, maybe a 4.2 number, something like that. Fannie Mae projecting that existing home sales could have a 10% increase. That would put us at around 4.4 next year. They've kind of tempered that down to a 9% increase, but still, that's a lot of sides when you look at what could happen next year if Fannie Mae's right. I think it's a little bit, I love that it's bullish and I want it to happen. I think that it might be a little bit too much, just based on some of these misses that we've had the last couple of years. We're trending at 4 million once again. 1.53 million homes are for sale year over year nationally. That's a near 12% increase. 4.6 months of supply on existing versus the 7.4 on new. So existing home sales months of supply August over August has moved up 4.2 to 4.6, while new home sales has moved down from what was 9.8 a year ago to 7.4 here today. The median sale price right now on existing home sales is higher than new. Remember, new moved up from July to August from being in the high threes to 413,000. Now, for this report here on existing home sales, coming in at 422,000. So almost a $10,000 dollar increase on existing home sale prices for versus new. So just an incredible number there. If we look at total home sales right now, again, this 4 million number is, I mean, if you go back in time, this is great financial crisis numbers. This is 1995 numbers. These are low numbers. And that correlates back to mortgage application data, where we'll look at that here in just a second. But we've seen the lowest mortgage application interest over the last 3 years, as we did in GFC and 1995 levels. So 4 million, a long stretch from the 6.4. If Fannie Mae's right, we can get back to kind of this early 2022 level of around 4.4. That'd be quite the improvement from where the market has been and continues to sit. Median price of existing home sales, 422,000. These numbers, continue to move up. We're getting the seasonality drive down, but that seasonality push down on median price happens each and every year. It's why I just mentioned earlier, April is the most advantageous time, maybe March, for a seller given a particular market. What they care about is making the most money, because the most money happens right here during that kind of June time period when you look at a monthly median sale price on existing homes. Median price right now is up 2% year over year. Existing home sales is up 1.8%. So this is an improvement from really the majority of the year. We got to go all the way back to January to get a 2.3% year over year increase on total existing home sales. We had an increase of 0.8% last month. We get it up to 1.8 here this month. Realtor confidence, according to NAR, first-time home buyers are 28% of the market versus 26% when polled last August. Sales to investors, 21% right now versus 19% a year ago. Cash sales coming in at 28 versus 26 a year ago. Distressed sales is up at 2% versus 1% a year ago. And days on market up 5 days from 31 to 26. The South makes up the majority of the sales by region. Of course, the South region, as NAR breaks up the 4 region, includes Texas and Florida. So that makes sense. The Northeast is in the 4th spot, coming in at 12% of total sales. The West at 18 and Midwest at 24. The price ranges that make up the majority of the sales nationally are still, all happening under 500,000. You've got 0 to 1, not a big category, but 1 to 250 and 250 to 5 makes up the majority of the sales. And then you've got 5 and up making up, obviously, the rest of the sales there. All right. That's your existing home sale report that we missed earlier in this week. Wanted to get you caught up on that. If you go into, by the way, because I'm throwing a lot into this hot sheet here. So for our BAMX members, all you got to do is jump into school. We'll have it all broken down for you. If you go to your hot sheet classroom right here, and jump in. We're going to have all of the slides uploaded. There's a ton of slides, obviously, today. But we do this every single day. All the slides, all the hot sheet show notes get categorized into the hot sheet classroom for you. We've got past months. And then as we close out a quarter, we give you past quarter most popular charts. All of that's available for BAMX members at school.com/BAMX. If you go into hot sheet classroom, and then every single week we drop new listing templates, hyper local templates, housing market data templates, video scripts. Eric, the broker agent, and the team, Bobby and Vanessa and Jill, the entire team create this content the same way we create our BAM content directly for you, and give you those drops each and every single week. So if you're interested in grabbing the hot sheet stuff or some of the other social media stuff, just go to school.com/BAMX and you can grab all of that. Today's BAM, hot sheet drop is large because we're packing in obviously everything that we've missed throughout this entire week. Okay, we just covered existing home sales. I want to take a look here at pending home sales. Pending home sales is showing what Altos showed in the previous report, that we are starting to see an increase, which could bode well for existing home sales in 60 days. We could see a little bit of an unseasonal pop there on existing home sales if these deals stay into contract. We have seen higher contracts, cancellations rather. So if they stay into contract, we'll be in good shape. But 4% pending home sale report for August. Okay, so you've got gains in the Midwest, South, and West. You had a decline on pendings in the Northeast, where you have the lowest levels of inventory, but where you have the most options in these three regions, they all saw gains on pending home sales. So buyers responding to optionality and a little bit of the relief on the rates, 3.8% increase year over year on pending home sales. Month over month, it comes in at 4%. So really good numbers there on pending home sales. Continues to follow the trend that we've been seeing. All right. Is that trend going to continue here throughout the year? In order to know that, we need to know what mortgage applications are doing. We have a mortgage application report come out yesterday, and the headline numbers not great. It's 12.7% to down to the downside, according to Mortgage Banker Association for the week ending September 26. Okay, so the 12 plus percent on the headline number includes refis. Refis have decreased 21% from the previous week. Still 16% in the higher than the same week a year ago. But when you got that little bit of an increase on interest rates, you saw the refis kind of pulled back off. And anybody thinking about refining, will wait to see if they can get a little bit more leverage on the rate down the road. The purchase index, though, we also had some bad news. It's only 1%, so it's not that bad, but it is a move down, and it's the first move down in quite some time. It's a 1% move from a week earlier on purchase application. Now, listen, time of year, totally expected. Like, to get this move down on this purchase index it's normal. Okay. But we're just getting like accustomed to all these week over week gains. We had it for multiple weeks in a row. When we look at year over year, 16% higher than the same week a year ago, that's still a great number. We've got double digit, obviously gains there, but we finally broke the weekly streak and in our recovery to kind of get out of this GFC level of mortgage applications that we still sit today, this 1995 level. And we'll continue to see what happens there. All right. So there's your mortgage application update. Moving now into some of the home price indices. I'll go through this quickly. You'll have all the information uploaded into school too, where you can grab it there. We'll reference it back as we do, as we get into other categories moving throughout the month, as we typically do reference what this gold standard of home pricing says. The S&P Dow Jones indices, this is the Case-Shiller, this is the gold standard. It's a lagging measurement because look, we're looking at July and this was just released. So here's where we're at on the gold standard on what's going on with U.S. home prices nationally. Okay. All of them are continuing to display overall growth. Okay. So the U.S. up 1.7%, the 20 city composite and the 10 city composite up 1.8 and 2.3% respectively. So all indexes showing year over year as of July home price growth. Okay. So sorry to everybody on X calling for a, catastrophe in the housing market as it relates to prices. Still not seeing it nationally. Housing wealth slipped. July's 1.7% national gain, lagging the 2.7% rise in prices. Remember, even 1.7% growth, which is, by the way, that's where we're at right now. That's exactly where Logan Mohtashami has projected the home price growth. As it's near Zillow's numbers is where we're going to end year over year. I mean, you're looking at an under 2% number. That's, factoring in inflation. It's basically a negative number. I mean, I don't call it negative, but a lot of these analysts say, hey, it's net negative when based off inflation on home prices. It's basically like, hey, nothing's happening, right? You're moving flat. Home prices aren't really going anywhere. But if you look at the core number here, it's 1.7 up, moving up. All right. Just going into, let me just pull up the 10 city or I'll pull up the 20 city and we'll just go a little bit locally. Here we go. This is what I'm looking for. All right. 20 city, on this, Case-Shiller index here. Okay. Atlanta is a move up for the year, but for the month slightly down. If you look at the month, almost every city in the 20 city is down except for Portland and Minneapolis and Cleveland and Chicago. Okay. Detroit. So I missed Detroit there. So only a handful of the cities here from June to July move up. Now, this isn't uncommon. There's a seasonal factor to this month over month. I would expect to continue to see moves down. Now, this seasonal factor kind of happening a little late. I mean, June to July. Yeah, you'd like to see those numbers go up. 1 year change nationally up 1.7%. This 20 city is up 1.8. But that's being carried by some of these big gainers. Like Boston's got a 1 year change of 4%. Chicago's got a 6%. Detroit's carrying at 4%. You've got New York City still at the top of the list at 6.43%. Okay, so that's kind of making up for the areas that are seeing a decrease. Tampa now, maybe the biggest 1 year decrease I've seen to date. Year over year, they're down almost 3%, 0.5%, June to July. So I expect that number probably to get bigger as we go through the end of this year. Knock on wood, Tampa. I mean, I'm right there with you here in Naples. Knock on wood. You know what I'm talking about. We've avoided something here, and I'm hoping we continue to avoid it for the next number of weeks. That'll help if that happens. You don't have any weather issues. That'll help places like the Gulf Coast in Florida, where there is some element of buyers doing a wait and see approach. Hey, prices are down, but if something hits, they'll come down more. Nothing hits. Oh, maybe I move in before the traditional spring market, before that seasonal market hits. Maybe some of those buyers start to move in the end of the year and change the game in places like that. So there's all these dynamics at play when you look locally. Phoenix, was just in Phoenix, obviously for BAM camp, and you've got inventory increasing there. The prices from June to July moved down almost 0.8%. Year over year, it's down 0.9%. So Phoenix market generally moving sideways. Miami's down 1.3%. Dallas is down 1.25%. So Florida and Texas continue to see the biggest drops, generally speaking, on home prices. But year over year, Case-Shiller has the home prices moving up on all indexes, whether it be national, 10 city, or the 20 city composite. So big numbers there. As we look at FHFA and see kind of where they're sitting, they've got the month over month down as well, down 0.1% in July, but 2.3% up when you look year over year, July over July, 2.3% nationally. And then as they have their 9 census divisions, I'll pull those up and we'll just take a look at where those are coming in. You are starting to see, I mean, this is kind of my favorite chart that shows that, hey, real estate always just continues to go up. You are seeing kind of this little, a little bit of a dip off here. I do expect rates come to a 5 handle if that happens. And, we get into a spring market. This isn't going to be some kind of we're not going to see one of these great financial crisis. There's nothing that suggests we'll see that, but it could just be one of these kind of little blips on the radar here before you start seeing prices move up. But you are seeing the cooling off here of elevated prices, reflective in one of my most favorite charts to help buyers understand that, hey, generally speaking, home prices always go up and to the right. 12-month home price changes per the 9 census divisions as FHFA looks at them. You've got year-over-year price changes in all region that are to the positive. The Pacific region being the lowest price gainer at 0.2%. The South Atlantic coming in at 0.8%. The big gainers, the Mid-Atlantic 5.1%, New England 3.9% for this year, and East, North, Central 4.1%. All regions here as FHFA looks at these prices are under where they were the year prior. So July 2023 to July 2024, and US coming in at 2.3% versus the 23 to 24 number of 4.8%. So home prices definitely moving in a downward direction, even though you're seeing annual gains there. All right, jobs. This is the one we got to take a look here at jobs and what's going on. This is the one that's driving most of the rate conversation, as we know from the previous weeks. If we look first here at job openings and labor turnover, we had a Bureau of Labor Statistic report that came out on Tuesday, just to catch up on speed on that. If you haven't seen it, number of job openings was unchanged in August at 7.2 million. So openings are still out there. They're available. It's 7.2 million. It's not where we were at 11 million, creating concern for inflation in jobs. It's right there at 7.2. Hires and separations were unchanged at 5.1 million. And with separations, both quits and layoffs, 3.1 million on quits, 1.7 million on layoffs were little change. So these numbers are not, moving from where they've been. It's been kind of a normal number. Really nothing to see there as it relates to the labor turnover number. More of exactly what we've seen, and not much to be concerned about on that front. All right, so let's look at ADP employment. These ADP employments have moved the markets in the past, and they have their most recent report out here as of yesterday. So ADP reports the private sector employment shed 32,000 jobs in September. Pay was up 4.5% year over year. So pay moving up while jobs are moving down. Regionally, private employers shedding this 32,000 jobs in September. Where did they shed these jobs? Okay. Goods producing down 3,000, service jobs down 28,000. So the trades, the financial activities, the professional business services, markets like, or industries like real estate. If you look at, I think that could be, I think in real estate in particular, not necessarily service jobs where you're the 1099, but I think there's going to be, over the next 12 months, a reduction in with some of the acquisitions that we're seeing. There's going to be a reduction in executive staffing across this industry, unfortunately. Northeast, for regions that lost the most jobs, Northeast wasn't one of them, gained 21,000. The Midwest lost 63,000. The South gained 3,000 jobs, and the West gained 15,000. So it was really the Midwest that took the brunt of this job loss here, according to ADP's October 1st report on unemployment. Okay. So there you go. That is your kind of crash course on the week that we missed here for the hot sheet. I do want to just take a moment to kind of check in with you guys where we're at on the 30-year fixed rate and where we might be heading here with the 10-year. So 30-year Not really changed at all since the last time we were together. Coming in exactly really where we were, 6.37. It hasn't moved. Okay. So the momentum that was lost after the Fed meeting, and you saw the rates pop from a year-to-date low of 6.13 up to this range of 637, 638, 639. We've been stuck here for a couple of weeks now. And we kind of continue to just hang here until the next piece of information that the market Market, by the way, on government shutdown, really kind of no reaction. Okay. So it's just like, the kids are fighting again. Let's maybe we'll give them some popsicles once they calm down, but nothing to see here. A little bit of tears, a little bit of screaming, and they'll calm down. They'll figure it out. We'll give them a little popsicle. Markets don't seem to care. 10-year coming in at 4.113. It's, it's where we've been. I mean, look at the last month. I mean, what the shutdown happens here and the 10-year doesn't blink an eye. Like, yep. Just normal dumb politicians not being able to get together and figure out a deal. So market having no reaction there. If we look back on the last 90 days on the 10-year, still in a favorable spot versus the majority of where we were over the last 90 days. So we lost that, that momentum that we had before the Fed meeting, but we didn't go all the way back to where we were in, say, August or July. We're in a much better spot there. 4.113 is where we enter the day today. We're still seeing CME Group as well as Polymarket both project with 27 days until the next Fed meeting that we will have a cut. In fact, CME Group is so confident, less than 30 days out, they've got it at 100% chance that there will be a cut. They have a 99% chance that it'll be a 25 basis point cut and a 1% chance that it'll be 50 basis point cut. Wouldn't that be something to see if that were to take shape? Polymarket right now, let's get a refresh on Poly because I think these are higher. Yeah, there we go. 90% on Polymarket, chance for a 25 basis point cut. And then 4% on a 50 basis point cut. So Polymarket's at 94%, where people are actually putting their money down to bet on this deal. And they're at a high percentage as well. So likely to see a cut. Love for it to start leaning closer into that 50 basis point cut, which I was supportive of for this last meeting, which obviously did not happen. Okay. If you happen to miss me at BAM Camp, the rest of the BAM team, or miss me at Sirhant recently or Jared James Advance, in 20 days, I'll be delivering a keynote at the Fusion Rally. This is in Denver, Colorado on October 24th, Fusion Rally 2025. I'll be doing the keynote at this one-day event. If you are in any proximity to Denver, I'd love to see you there. It's we got the link down below, growwithfusion.com. And there's actually right now, before they get a couple weeks out, they're doing an early bird pricing. And BZ25 is 50% off the ticket. That's a BAM deal. So go to BZ25 when you claim your ticket. Make sure you put that code in so you get 50% off of the lowest ticket. For the BAM community. I'll be delivering the keynote. If you're in that Denver area, if you're going to Denver, interested in going to Denver for October 24th, I'd love to see you there and chat with you then. All right. I'm gonna have a Knowledge Brokers tomorrow. Myself, Tom Toole, Lisa Shanati over on a separate channel. Go over to, if you love the hot sheet and you missed the hot sheet, don't miss Knowledge Brokers tomorrow. Go over to Knowledge Brokers podcast, whether it's you listen to the audio on Spotify or Apple. Love for you to consider leaving a review to this hot sheet if that's how you listen to it, or Knowledge Brokers, or the YouTube channel, and subscribe there. We'll have a new Knowledge Brokers tomorrow, and looking forward to covering. There's a whole bunch of industry talk this week, so if you're looking for that, that's where we're going to be covering it tomorrow. I mean, a lot of lawsuits are popping back up. There's just a lot going on the industry side. And we'll be getting it all straightened out on Knowledge Brokers tomorrow. See you guys over there. Until then, toodaloo.